Scene script. Imagine being able to predict the future, to know what's coming before it hits. That's the kind of power financial knowledge can give you. Financial knowledge isn't about clairvoyance or fortune-telling. It's about understanding the ebb and flow of the economic tides and being able to navigate your ship accordingly. It's about being in control of your finances rather than letting your finances control you. When you understand financial concepts, you can make informed decisions. You can weigh the pros and cons, calculate risks, and forecast potential outcomes. This doesn't just apply to big business tycoons or Wall Street traders, but to everyone. Whether you're a college student managing tuition fees, a young professional saving for a car, or a couple planning for retirement, financial knowledge is a tool you can use to shape your future. Now, let's talk about asset classes. The term might sound complex, but it's really just a way of categorizing your investments based on their characteristics. Stocks, bonds, real estate, commodities, these are all different types of asset classes. Each one behaves differently, has its own set of risks and rewards, and plays a unique role in your financial strategy. The same goes for investment options. There's a whole world of opportunities out there, from buying shares in a promising startup to investing in a mutual fund to purchasing a rental property. But without financial knowledge, these opportunities might as well be locked behind a door. Understanding your options is the key to unlocking that door. So, why is all of this important? Because financial knowledge empowers you. It gives you the ability to shape your own destiny, to make choices based on understanding rather than guesswork or fear. It's the difference between being at the mercy of the economic winds and being the captain of your own financial ship. Remember, knowledge is power, and financial knowledge is a superpower. Did you know there are several different types of investments, each with its own set of risks and rewards? That's right, these are known as asset classes, and we're about to dive right into them. First up, we have stocks. When you buy stocks, you're buying a piece of a company. It's like being a mini business owner. The risk? Companies can go under. The reward? Companies can also thrive. And when they do, so does your investment. Next on the list are bonds. Think of bonds like a loan. You're lending money to a company or government, and in return they promise to pay you back with interest. The risk here is that the entity you lend to might default on their loan. The reward is the steady income you receive from the interest payments. Moving on, let's talk about real estate. Buying property can be a great way to generate income, whether through rent or selling at a higher price. The risk? Property values can decrease. The reward? They can also increase, and if you're renting out your property, you've got a steady stream of income. Finally, we have commodities. These are physical assets like gold, oil, or even agricultural products. They're a bit different from the other classes we've discussed because their value is largely tied to supply and demand. The risk? Prices can fluctuate wildly. The reward? If you play your cards right, you can make a tidy profit. Each of these asset classes has its own unique characteristics, risks, and potential returns. Some might suit your financial goals and risk tolerance better than others. The trick is to find the right balance for you. Understanding these asset classes is like knowing the rules of the game. It can help you play better and win. So, get out there, make informed decisions, and start building your wealth. Now that we've cracked open the world of asset classes, let's delve into the various investment options available. A kaleidoscope of opportunities awaits you. It's like stepping into a candy store, with each candy offering a different flavor and a unique experience. Let's start with mutual funds. Think of them as a basket of various investments managed by financial experts. The advantage? You get to diversify your portfolio without having to buy individual stocks or bonds. However, keep in mind that mutual funds come with management fees, and your investment's performance is largely in the hands of the fund manager. Next up, we have exchange-traded funds, or ETFs. They're similar to mutual funds, but with a twist. ETFs are traded on the stock exchange, meaning you can buy and sell them throughout the trading day, just like individual stocks. They offer the flexibility of stocks and the diversification of mutual funds, but remember, their price can fluctuate throughout the day due to market conditions. Moving on to real estate investment trusts, or REITs. These are companies that own or finance income-producing real estate. Investing in a REIT allows you to dip your toes into the world of real estate without having to buy property. It's like buying shares of a company, but in this case, the company deals with real estate. The potential downside: REITs can be affected by factors such as property market conditions and interest rates. Lastly, we have individual stocks and bonds. Buying individual stocks lets you become a part owner of the company. It can be exciting and potentially very rewarding. However, it also carries more risk, as your investment depends on the performance of a single company. On the other hand, bonds are like loans you give to a company or government entity in return for regular interest payments. They're generally considered safer than stocks, but their return potential is also lower. Remember, there's no one-size-fits-all investment. The right choice depends on your financial goals, risk tolerance, and investment horizon. Investing isn't just about making more money. It's about making your money work for you. Now, doesn't that sound like a deal you'd want to make? The beauty of investing lies in its ability to multiply your wealth without you having to actively work for it. One of the key benefits of investing is the magic of compounding. Albert Einstein once called compounding the eighth wonder of the world. It's a simple concept, really. You earn money on your initial investment, and then you earn money on that money, and so on. It's like a snowball rolling down a hill, growing bigger and faster with every revolution. But the benefits don't stop there. Investing can also provide a regular source of income. Take dividends, for instance. These are portions of a company's earnings distributed to shareholders. You could be sitting on your couch, binge-watching your favorite series, and boom, your bank account receives a pleasant surprise. And who doesn't love a surprise, especially when it adds to your wealth? Investing also offers financial security. It's a safety net that can help you ride out financial storms. Life is unpredictable. You might face unforeseen expenses or income loss. But with a well-diversified investment portfolio, you can weather these uncertainties with a bit more peace of mind. Lastly, investing can help you achieve your financial goals faster. Whether you're saving for a dream vacation, a new home, or a comfortable retirement, investing can get you there quicker. It's like taking a high-speed train instead of a slow-moving bus. So, what's the bottom line? Investing isn't just about accumulating wealth. It's about leveraging that wealth to enhance your life, secure your future, and potentially even make a positive impact on the world. Investing is like planting a tree. The sooner you start, the more time it has to grow. So, are you ready to plant your money tree today? While investing has its benefits, not investing can be just as impactful, but in a negative way. You see, when you choose not to invest, your hard-earned money doesn't grow. It just sits there. And over time, inflation eats away at its value. Imagine a loaf of bread. Today, it costs $1. In 10 years, due to inflation, it could cost $2. If you didn't invest, you'd still have that $1, but it wouldn't buy you a loaf of bread anymore. And then there's the concept of opportunity cost. When you don't invest, you miss out on potential growth. Let's say you had $1,000. If you'd invested it in a simple index fund 10 years ago, you could have doubled or even tripled your money by now. But if you just kept it under your mattress, you'd still only have $1,000. Not investing is like leaving money on the table. It's a choice you might regret in the future. We've journeyed through the world of financial knowledge, explored asset classes, and dived into investment options. But it all comes down to one thing. We've walked the path of understanding the power of financial knowledge, the significance it holds in our lives. We've unraveled the mystery of asset classes, how they function, and their role in diversifying your portfolio. Together, we've explored the myriad investment options available to us, each with its unique benefits and risks. We've also looked at the brighter side of investing, the immense potential it holds for wealth creation and financial security. Conversely, we've delved into the disadvantages of not investing, the missed opportunities, and the financial instability it can lead to. All these elements intertwined form the basis of sound financial planning. They empower us to make informed decisions, to choose the right path in our financial journey. Remember, when it comes to your finances, you're the captain of your ship. So arm yourself with knowledge, make informed choices, and set sail towards your financial goals. Don't forget to subscribe to our channel for more financial wisdom.